In today's interest rate environment, it is really tempting to load up on short duration bonds, whether it's money market accounts, whether it is CDs or treasuries. Right now, the shorter the security is, the higher the interest rate. And because of that, a lot of our clients are looking to load up on some of these shorter securities. These next two slides, I want to show you why that may not be the best decision. Now, first, for some of our clients, they have excess cash in checking, savings that make up their emergency cash. For those clients and that cash, repositioning to high-yielding money market accounts, CDs, or treasuries absolutely makes sense. That's a perfect use for those securities. On the other hand, we have a large portion of our clients that have some segment of their portfolio is going to be in bonds for the long term, for essentially the remainder of their lives. For those clients, we strongly discourage them from going entirely short duration for the reasons we're going to lay out in these two slides. So first, today's challenge of reinvestment risk. Reinvestment risk is essentially, like we're looking at in option one, if you buy a short security, in this case, a one-year bond paying 5%, and interest rates start going down, when that bond matures, you have to buy the new bond at the lower interest rate. And when that bond matures, you're buying a new bond at the lower interest rate. So in this scenario, we started at 5%, and over the next 5 years, interest rates go down to 1. In option two, we buy a 5-year bond that's paying 3.5% now, but it's locked in for the next 5 years. What you find is that over the 5 years of holding this security versus the 5 years of reinvesting your cash 1 year after the other, you end up better off in scenario two than you did in scenario one. And so again, this is hypothetical. These are not exactly where rates are today, but the same premise is true. If all you have is short duration securities, as interest rates do start to come down eventually, we are going to be subject to reinvestment risk. And there's a very real chance that rates go back down to where they were a couple years ago. Bill Payne always likes to tell the story about when he got into the business selling CDs, and the 10-year CD was paying 10% and the 1-year CD was paying 12%. And nobody wanted the 10-year 10% CDs. They only wanted the 1-year 12%er under the thought that 12% is higher than 10 and rates will stay high or go higher forever. Obviously, in retrospect, it was a much better idea to buy that 10-year 10% CD. So again, rates are not as high today, but the same premise holds true. So this side, we're looking at what has happened historically after the Fed is done raising rates. So following the last Fed rate raise, what we see is that money market accounts, the shortest duration bond that's out there, has averaged 4.5% returns, whereas the longer duration bonds have had higher average returns. And the reason for that is because the longer the bond is, the more it's impacted by changes in interest rates. So when rates were going up, the longer bonds did poorly, worse than the shorter bonds. But after the Fed's done raising rates and rates do start coming down, what we'll see is that the longer term bonds will start increasing in value at a faster rate than the shorter term bonds. So again, this is not to say that all money market accounts are bad, all short-term CDs don't make sense. This is simply to say that when we're looking at a bond portfolio, it makes sense to maintain longer durations even when those longer duration bonds look like they're paying less than the shorter rate bond or shorter duration bonds today. If you have a question about this or anything else, just let us know. We'll be happy to help. Thanks again. Talk to you soon.